Hi everyone, welcome. Today we'll be talking about different types of mortgages. At the end of this, you should be able to explain what a fixed rate mortgage is, adjustable rate mortgage, balloon mortgages, as well as the benefits and drawbacks of each and when you might consider one type of mortgage or another. All right, let's get started. So there are three categories of mortgages overall. The first is called a conventional mortgage. This means that you meet the typical credit, down payment, income. You're a normal home buyer. You meet all the requirements. Everything's good. Who should apply? So this is anybody with a good credit score above about 620 who make enough money to easily afford the loan payments. And this is the thing we call a typical mortgage. You'll get the best rates with a conventional mortgage usually. The next type of mortgage is called a jumbo mortgage. These are for really large loans. Anything where the loan is above $760,000. So that puts the cost of the property above like in the $900 to over $1 million range. So if you're getting a jumbo mortgage, you're going to have to probably pay slightly higher interest rates than the conventional mortgage because it's riskier for the banks. And you're going to need a really high credit score. So here you're going to need a score above like 700. Money for the full 20% down payment, and you're going to need to have enough income to easily afford the payments. So jumbo mortgages are riskier for banks, so they're a little more careful about who they write these loans to. All right, the next one is a government-backed mortgage. This is where the government secures part of the mortgage. They tell the bank, hey, look, if this person defaults on the loan, we're going to make sure you don't lose any money on it or very much money on it. So this is less risky for banks. So now banks are willing to give loans to more people with lower incomes and lower credit scores. And it typically doesn't require that full 20% down payment. The first type of government-backed mortgage is called the FHA loan. This is for people who can't get a conventional loan because of lower income or lower credit scores, or they don't have that full 20% down payment. These loans typically only require a 3 to 10% down payment, and you can still get these loans if your credit score is in that sort of upper 500 range. If your score is really bad and it's in the low 500s to 400s, no one's going to give you a loan. It's just you need to build your credit score up first. USDA loans. These are just like FHA loans, but they focus on rural areas instead of cities. So if you're in this situation where you don't have a huge income, your credit score is maybe not perfect, you don't have that $100,000 down payment saved up, you can go try to apply for an FHA loan, or a USDA loan. The last one is a VA loan. So this is for veterans. This is to help veterans and their families, surviving families, be able to afford a house. These typically do not have any down payment requirements. You can buy the house without putting money down. All right, so this next section is about features of mortgage. These features can be found in any of those three types of mortgages. So this is the kind of flavors that each mortgage can come in. The first is called a fixed rate mortgage. The interest rate does not change, it is fixed. So you get an APR at the beginning, and that stays constant through the entire loan period. It can't be changed by the lender. They can't just come in and change it ever. It's fixed. This is the best loan for almost all borrowers. I recommend this loan when you go to buy property. Some of the pros of this: your mortgage payment stays constant for the entire loan. So because your APR is not changing, you know in 25, 30 years, your mortgage payment will be the exact same amount that it is right now. So it's fixed across the whole thing, so very predictable. The nice thing about this, if you start with a low interest rate, you keep those low interest rates for the entire loan. Of course, the opposite is true if you buy a house during a high interest rate period. You're going to have that high interest rate the entire time as well. It is also fixed. You can do what's called refinance, which is basically get a new loan halfway through your mortgage to get a lower interest rate. We'll talk about that later. Some cons of a fixed rate mortgage: if you start with that higher interest rate, you keep the high interest rate the entire loan. You can, like I said, refinance. We'll talk more about that later. But there aren't a lot of cons here. This loan makes the most sense for most people. The next type of mortgage you can get, or the next feature you can do, is what's called an adjustable rate mortgage. It's called an ARM. You might hear that when you're learning about buying a house. This is where the interest rate stays constant for a few years, and then it increases or decreases with the interest rates in the rest of the country. So it can bump up or bump down depending on how the economy and everything is going. Some pros of the adjustable rate mortgage. The main thing that people try to get into is that you typically start with a much lower interest rate. So bankers can tease you into this by going, oh, right now I can save you 1% in your APR by having an ARM. But just know that that rate is going to change during the loan at some point. So if rates consistently decrease over time, you will save money with an ARM. The hard thing though is predicting the future. Some drawbacks of an adjustable rate mortgage. Your payments can increase dramatically even with small increases in interest rates. So if interest rates go up by 0.5% or 1%, that might be hundreds more a month or up to $1,000 more a month in your monthly payments. So your payments can change constantly and get bigger and smaller. So if rates raise over if interest rates increase over time, which over 30-year mortgage, interest rates are going to increase at some point, more than likely, you could lose a lot of money in the long run as rates adjust. So this one just has a lot of uncertainty built into this loan because your interest rate will change, and that's going to have a huge impact on your monthly payments. All right. Then the last one is one that you should not do. This is called a balloon mortgage. This is a terrible product. I'm hoping someday the federal government will just outlaw and ban the use of this thing. So how this works is that the entire loan balance is due after a few years of paying the loan. So let's say you borrow $500,000 and you get a balloon mortgage. Well, that mortgage is really only good. It's spread out like it's a 30-year loan, but you have to reapply for the loan every 4 or 5 years, and that resets the interest rate every time. The trick of this, the pros of this, the reason why some people do it and get tricked into doing it, honestly, is that you start with a much lower interest rate. They know they're going to be resetting this loan, so they're only really giving out a 5-year loan. They're going to reset this loan in 5 years and get better interest at that time. The cons are big on this one. So if you have to apply for a mortgage every 5 or so years, that's an expense, and it's with closing costs, and it's a lot of uncertainty. In 5 years, it may be really hard to get another mortgage. You might find that you don't qualify because the standards of the banks have changed in those 5 years. They may say you don't qualify. You're going to end up losing your house in that case. And getting a new loan can be really expensive. There's closing costs associated with that. There's time and energy on your part associated with that. This loan requires lots of maintenance and uncertainty. And when you do get that new loan, it might be much higher monthly payments because the interest rate may have jumped up a bunch in the interim times. So by far, the best loan type that I would recommend for people starting out is that fixed rate mortgage. That way, you know from day one exactly what your payments are going to be. You're not going to get surprised every year or two with a huge change in your payments. All right, my friends, that's it for our types of loans. Hopefully that was helpful to you. We'll talk to you soon.